Today, as part of our continuing education series, I want to talk about margin lending. First of all, I want to explain what margin lending is. A margin loan is effectively a flexible line of credit that allows you to borrow money to invest in for investment purposes. It might be in shares, it might be in managed funds, it might be in investment property, which is a form of investment loan. Now, what happens is typically with shares and managed funds, you can borrow between 40 and 75% of the value of your securities, and that allows you to have more money invested. And there are, let's assume you have some investments now in shares and managed funds. There's sort of three things you can do, opportunities you can look at for margin lending. You could set up a new portfolio in terms of add more shares to your existing portfolio by borrowing some money against your existing investments. You might want to increase the size of your existing portfolio, buy more of the same securities, in which case you could borrow some money against the existing portfolio and increase the size of your positions. Or you could free up some capital. You might have a share portfolio or a managed fund portfolio, and you decide you need some money for a home renovation or a holiday or a new car. You can actually borrow money against your share portfolio and take those funds and use them for your renovation or your holiday. So in summary, margin loan is an investment tool. It's a way of borrowing money to leverage or gear your portfolio, and allows you to increase your exposure to the market. Good debt versus bad debt. I guess ultimately, good debt is debt that allows you borrow money to finance an asset that provides income. It might be an investment property, it might be a share portfolio or a managed fund portfolio. And that good debt allows you to deduct the interest. So for instance, if you have a share portfolio and you borrow money for a margin loan, the interest on that margin loan, the purpose of the loan is to create income. So the interest on that loan is tax deductible. So you get some tax assistance from the government because you're actually borrowing money to create an income stream, whether it be dividends and shares or rent from an income property. Now, bad debt is any debt where you're not able to get a tax deduction for the interest. So you're paying the interest with your own after-tax dollars. So if you think about it, bad debt examples are car loans, credit card loans, personal loans for holidays or whatever items. If you borrow money personally that's not for income producing purposes, you're paying interest with after-tax dollars. So if you consider the difference between borrowing money at, say, 7%, that's tax deductible. If you're in the top tax bracket of 46%, your cost is like 3.6%, versus if you borrow money that's not tax deductible and costs 7% interest, that 7% is after tax. So you have to make almost 12% of your money. You would be the equivalent of making 12%, having to earn 12% to pay 7% after tax. So in essence, good debt is any debt that's tax deductible, where the interest is tax deductible, and what you need to do in that sense is very much, if you borrow money for investment purposes, you need to clearly be able to show the tax office that the money is borrowed for an investment purpose to generate income. And so I always look at people who often people use their home as a line of, as a source of equity. They'll take a home equity loan and use that to make other investments. If you do such a thing, make sure you segregate that loan so that if there was ever a question to the tax office that this money is clearly earmarked for investment purposes. And when it comes to bad debt, the key is eliminate your bad debt. So when you're looking at things like credit card debt, personal loans, car loans, or any debt that's not tax deductible, attempt to keep those debts to a minimum. Over the past year, with the global financial crisis and some high-profile, casualties with Alco Finance, certainly Babcock and Brown. If you look at two big margin lenders that went out of business that were Opus Prime and Lift Capital, margin lending has been given a bit of a bad name. Now, is margin lending good or evil? I think is not the question. It's more along the lines is margin lending a tool when used properly that can help you create wealth? So let's address the Lift Capital and Opus Prime scenarios. They weren't typical margin lenders in that they actually borrowed money or allowed investors with very illiquid shares to change title for their shares to the margin lender, and they in turn pledged those shares to Merrill Lynch and ANZ. So that effectively is basically giving your shares to someone else and borrowing money against them. In a typical marginal lending scenario from any of the big banks, what you're looking at is taking a mortgage over your investments or your security. It's like a mortgage over your house. You don't pay your mortgage so they can sell your securities. Now the key to, I guess, managing the risks of marginal lending is to look at how much gearing you do, or you take on. You can basically gear your portfolio up to 75% in many cases. I don't recommend that. I recommend that people who are using gearing either use a regular gearing facility, which is borrowing a set amount on a regular basis and investing a set amount every month, and that will allow you to average into the market. It minimizes your risk of timing. Or look at keeping your gearing levels in that 50% range, so you have a 25% buffer in terms of the market dropping. Now, if you think of the recent storm financial, people had high levels of gearing, and then they had loans on their houses, which is like double gearing, and they're in a market that dropped 40% in a year. So it created a massive downturn. So what I recommend to people is that if you're using marginal lending, to use it judiciously. So gearing levels probably no greater than 50%, so you're geared sort of 2 to 1, and use it to develop wealth over time. You need to have a long-term investment horizon. Some benefits of marginal lending would be you can choose the gearing level, you can look at the interest rate options, you can start small and develop your portfolio over time. So in effect, marginal lending is no other good nor evil. It's just considered as an investment tool that you can use and take the time to understand the risks and the rewards of using marginal lending. When you're considering gearing or marginal lending, there are a few key points you need to consider. I guess firstly is the interest rate. I think you should shop around and try and get the best and lowest interest rate. Now, if you're using, you'll find most of the banks are fairly competitive, but 2020 we have a special marginal interest rate with St. George, which is 0.4% below the general public offer. The other thing you need to consider is, if you're going to borrow money, you're going to have interest payments. So you need to keep the gearing levels to a point where maybe the income from your investments match your after-tax costs of the borrowing. You need to look at your investment time frame. And if you're investing in shares, you need to have an investment horizon of 5 to 7 years. Certainly, over any 5 to 7 year period, you should have positive returns for shares. And so your gearing program should be lined up with that sort of time frame in mind for share investing. Now, you also will see some capital guaranteed products that are capital guaranteed 7 years from now or 10 years from now. And I see that more as a marketing ploy. What you really need to look at there is what are the interest rates in these products. Some of them are double digit, 10, 11, 12%, which include interest rate and degree of financial engineering to incorporate the guarantee. I really feel that if people are going to look at gearing into the share market, they're better off setting up their own gearing facility and taking a prudent gearing facility of a ratio of about 50% and looking at a 5 to 7 year time horizon.